Very excited to be accompanied by some of my esteemed colleagues and peers in the industry, which I will introduce in a few minutes. I'm Candice Dott, and as my name kind of suggests, I'm extremely passionate about connecting dots, something I've done my whole life. It's something that I enjoy doing, and I'm hoping that today is all about sharing some of those dots with you, and hopefully you get to connect some of them as I have throughout my career, and also learning to prepare for today's session. There are a couple of dots connected there. We've got lots of personal stories to share, lots of lessons learnt, tons of tips, and lots of experience to guide you on a few topics that really should help you with your planning and acting. And hopefully from today's call, we can pretty much guarantee that you're going to have a few actions. So make sure that you've got your notepads or wherever you take notes these days, because you're going to have a couple of pointers that you're going to need to pick up along the way. I also happen to work for the London Stock Exchange Group. I work in the Global Sustainability Strategy and Execution team. So I'm super passionate about sustainability too, but that's for another day. Today I'm going to co-pilot our session, and we've got time together for about the next hour and a bit. And I think really from a LeadersWalk perspective, I've joined many of these sessions in the past. When we chatted and prepared for today's session, it was really important to all of us that we left with some practical and very actionable outcomes from today. So we're hoping that we leave you, and individually, those could be very different, but we wanted to make today as practical as possible, and really sharing ideas, discussing a lot of the ideas that many of us love, cherish, and get involved in our day-to-day business. So what is today all about? Today is about discussing your financial freedom. And we're not quite sure that everyone actually agrees with that term, quite frankly. Is it about health? Is health the new sort of wealth? Is it important for us to be planning this and making sure that you factor this into your priorities every day? And really, what sort of actions can you take from today onwards if you haven't taken some of those already? And who are we? And it's kind of nice to say we, because we has a whole different dimension when we're talking about the speakers today. All of us that are speaking are from the Women in ETFs South African chapter. We all sit on a panel where we all volunteer. We all have day jobs, but we volunteer and contribute back into the ETF industry in South Africa. There are a number of our colleagues who we work with in this chapter who are on today's call as well. And what it really allows us to do is come together in forums like this, connect networks, and share with each other. And I think importantly, for those of you that don't know what WE is, Women in ETFs is a global network. We are on the local chapter, as I've said. Our speakers are all volunteers. What is an ETF? Well, an ETF is an exchange traded fund. Hopefully throughout the session, you'll learn a little bit more about ETFs, because I think some of them are examples that will be shared. It's certainly one of the fastest growing segments in the financial services industry globally. Women in ETFs brings the ETF industry together. It's a global industry, but we like to champion ETFs within different regions. And our goal is really about actively choosing equality, diversity, and inclusion. And our mission is to develop and sponsor talent, recognize and honor the achievements of women in the ETFs industry, and invest back into the ETF industry. So I think really to bring that to life, just locally, we do some pretty amazing things, and the team and many of those members are actually listening in today, but can share some anecdotes and some tough questions, I'm sure. But we do quite a lot of university outreach. A number of the colleagues that are speaking today have been speaking to universities across the region, helping upskill, deepen, and develop knowledge around ETFs, but also around mentoring people in the industry and helping people get into the industry, understand what the industry is all about. And I think Amelia will be able to share a few more details later if you're interested in joining. We absolutely welcome male colleagues into the WE family. So this is absolutely part of who we are. And welcome to WE today. Some of the WE members that will be speaking, Candice Payne, one of my favorites. Candice is an independent financial advisor. She's been my co-pilot the whole way through preparing for today. And Candice is a highly skilled and trusted financial advisor based in Cape Town. I've worked alongside Candice in different capacities for some time, so I've gotten to know her. She's got extensive knowledge, extensive industry experience, and really focusing on financial planning and investment strategies. She's established herself as a go-to expert for individuals and businesses seeking to navigate the complex world of finance and helping people achieve their financial goals. Candice is dedicated to her clients and helping her clients make informed decisions about their finances. And she takes a truly holistic approach to considering each client's unique circumstances and goals to develop their personalized financial strategies. Hi, Candice.
Thank you, Candice.
Hi.
Hi.
Our second speaker that you will hear from today is Amelia Maharaj, who is loving the warm weather in Cape Town today. And I can vouch for the fact that it wasn't so great last week. Amelia is a chartered accountant and currently leads the investment operations team at 10X Investments. Amelia is passionate about changing behavioral patterns within organizations so as to create equal opportunities for women in the workplace, and believes that the first step to achieving this is ensuring women support and guide each other through the everyday difficulties experienced in the corporate world. Hey, Amelia.
Hi, everyone.
Our third speaker is Renee Basson. And I have had the privilege of working very closely with Renee because we used to work together. Renee is head of brand and responsible for the Satrix marketing, brand, communications, and client experience. She has a passion for building brands and sales, and I can vouch for that, and leverages sales momentum through the implementation of international and South African marketing programs with a keen focus on marketing operational excellence. Hey, Ren.
Hi, everyone. Nice to see everyone.
And last but not least, Tembeka Khumalo. I've gotten to know Tembeka over the last few years, and she is the Senior Client Relationship Manager at Satrix. And Tembeka is responsible for the overall client experience across the Satrix platforms and oversees the quality assurance, operating efficiency, and the training for the Satrix Now client engagement team. Hi, Tembeka.
Morning, everyone.
So we are going to get started. And really the format of today's session is to talk a lot about and help unpack the financial wellness, what that means, how you can practically think about this. And I'm going to hand over to Candice to unpack this for us in a bit more detail. I think she's got a pretty cool term that you're going to love.
Thanks, Candice. How long do I have? Just so I keep on track.
15, 20 minutes.
Okay, great. I'm going to share my screen. Okay, can everyone see the screen? I can no longer see anyone, but I'm hoping you're all looking at me.
Yes. All good.
I mean, my slides, not me.
No, the slides look great.
Okay. So as Candice said, the question that we had when we were setting up the talk and wanting to leave you really with some information that was useful and not confusing, because finance can be very confusing and personal finance even more so, is wealth the new health? And I think we might come to the end of this presentation by saying wealth is health, not necessarily new. So we also, on the journey, want to give you some resources to guide you when you're trying to figure out how to deal with your own personal finances. And one person who is out there is Morgan Housel, and he has written a book called The Psychology of Money. But one of the things that stuck out for me when reading that book was this quote: doing well with money isn't necessarily about what you know. It's about how you behave. And behavior is hard to teach even to really smart people. And I think that you can take this quote and put it to anything: doing well with your health, doing well with your relationships, doing well with your job. I'm wondering if everyone can maybe just put themselves on mute, because there's a bit of an echo. I'm not sure if you're all hearing it. And I think that you'll see that this thread will come through the whole sort of talk that I'm giving you now, is that you all know what to do with your money. It's really about how you behave, and it's our behavior that trips us up in life, in health, and in money. So I'm going to rename this financial self-care, because that really is what we're doing. Looking after your finances is caring for yourself, mainly because it reduces stress. So knowing where you are spending, where you are saving, and when you might reach your goals will reduce stress around money. It's just another box ticked in your long list of to-dos. And once you've got a grip on that, it does allow you to take care of others, whether that be financially or from a mental health point of view. So it's good for your health, it's good for your mental health, it's good for everybody around you if you have a good grip on your finances and you know where you're going with them. And then the fourth point, I think, is the most important one, is that it helps you to prioritize what you value. So here you really are going to have to look in the mirror and go, where do I want to spend my money, because I can't be spending it everywhere? What is really important to me in life? What are the things that I want to be doing? And I'm going to prioritize those. And if you circle back with knowing what is of value to you, you'll know where you want to spend your money and how you want to save your money. And it all comes back to this concept of financial self-care. So if we move away from the maxim of financial freedom or financial independence, or just knowing where your finances are, and think of it as self-care. So when I talk to clients, there are four kind of boxes that I can put them in. Number one is no freedom. People are just living from paycheck to paycheck. They don't know where their money is going. They're just on that treadmill, no goals. They think that maybe contributing to their employer's pension fund is going to get them where they need to be, but they have no concept. That is not freedom. Once we can move from that behavior to temporary freedom, where you are starting to spend less than you earn and you save the rest. So that little phrase is bandied around a lot, but it is hugely powerful. Spend less than you earn every month and save the rest. That's where you start building up a nest egg. Permanent freedom is where your non-employment income, and that's just a fancy word for your investments, starts creating more income than your expenses. This is where you can start making other decisions because you have annuity income. That's kind of where everybody wants to be. And that's also what retirement looks like, but we're not allowed to talk about retirement anymore. It's a rude word. And then moving on to luxurious freedom. This is where you are fabulously wealthy and the income from your investments far exceeds the spending that you require. So you need to decide where on that ladder you want to be, where you are and where you want to get to and how you're going to get to it. I think everybody in kind of the beginning steps wants to go for temporary freedom, where you are actually spending less than you earn and you are saving. And you're saving more than just into your retirement fund. You're saving to give you freedom, freedom to make other choices. You don't want your money to master you. You want to master it. That's basically the concept of freedom or independence and self-care. So how do we go about doing this? No, my slide's not changing. Oh, there we go. Okay, so the things to consider in your financial plan, there really are two broad areas. The boring one is protection, and the more exciting one is growing your wealth. The growing your wealth one is the one that we all want to talk about. That's where the ETFs fall into it. That's where your stock market investing is. But let's take a step back and look at protection, because we need to start there first. Make sure that you have a medical aid and that you have gap cover. Gap cover is the cover that is going to pay the gap, literally, between what a specialist or the hospital is going to charge you and what your medical aid will pay. And that can be enormous. Short and long-term insurances. I know this is dull, but we need to go through it. Short-term insurances are things like your car and your home, your cell phone, your laptops. Long-term insurance are things like life cover, dread disease, income protection, disability. This is when life throws you a curveball and you need to have something that's going to pay you out. And then most importantly, a will, and especially if you have children. Do not die intestate, that is, without a will, if you have children. A will helps you to look after your loved ones, and it's really important if you have assets to make sure that you have a will. Then if we move on to the more exciting stuff, growing your wealth, most people's biggest asset tends to be the home that they live in, and that's fine. You do need to live somewhere, and it does force you to save. Just make sure that you're paying off that mortgage as quickly as you can, especially in the South African context where interest rates are so high. Then we move on to retirement funding. You do need to know what old age is going to look like. If any of you have old parents, you'll know that it's not for sissies. When you are incapacitated, you're tired, you just don't feel like it anymore, you want to know that there's money somewhere to keep you going. And then there's all your other investments, and that's where it gets exciting, your offshore investments, your tax-free investments, etc. So those are the broad buckets when you're looking at your financial plan. I would prioritize them like this. First, old age. Old age really is difficult, and you need to know that you can afford it. Then there's your risk and medical insurance, and then your emergency funds. Emergency funds are for things like car tires, roof leaks. If you're in Cape Town, you'll know about roof leaks after this weekend. Children's computers that break down, those sorts of things. That really is the nest egg when you need to reach for money. And then secondly, we're growing our wealth and financial freedom. So I need to stipulate the protection bit before we grow the wealth bit. And then there's savings versus investing. What is the difference? Because these words are bandied around quite a lot. Saving is broadly short-term, investing is long-term. What is short-term? Anything less than, I would say, 3 years. There's no hard and fast rule. But if you need to gather money in an emergency fund, or you have short-term goals like holidays or school fees or buying cars, you are not putting your money at risk in the stock market. You are rather saving in something like a money market fund or a fixed deposit, something that's giving you an interest rate where there's a high level of guarantee. You don't want to lose this money, and you don't have time, because it's less than 3 years, to commit it to the market. The investing side of it is far more longer term. This is where you can take on risk. So if you have time, you can take on risk, and you should take on risk, because that's where you're going to get the best performance. Investing, you apply to things like your pension fund, which is committed to the stock market, other investment accounts, your tax-free savings account, offshore investing, and your property. Your property needs to be a long-term investment, the home that you live in, and try not to chop and change it, because the transaction costs around buying and selling property are exorbitant. So those are the two broad places that people kind of store their money, saving or investing. The three focus areas that I want to look at today, these are the sort of takeaways or the deliverables or the directives. Out of everything that I've told you about, I think these are really important. Dread disease cover, your retirement funding, and your tax-free savings account, and I'm going to run through them relatively quickly. Dread disease, also known as severe illness cover, pays you out a lump sum if one of these things happen to you and a whole raft of other things. This is hugely important, because when you do get sick, you do need money. You don't have time to think about your finances as well. So if risk is an affordability issue, so if you cannot afford risk cover and you have to choose one, this is the one that I would choose. Everybody's going to get something, okay, at some point. The younger you buy dread disease, the cheaper it is. And these are the kind of things that it pays out for, and it pays you out a lump sum. And if you buy a good policy, it can pay you out again and again. So I really would, from the protection point of view, look at something like dread disease. Then moving on to your retirement funding. And I know everybody glazes over when there's numbers on the screen, but stick with me here. The retirement funding and the tax-free savings account are where you're going to save an enormous amount of tax. Nobody likes paying tax, so stick with me here. This is really important. Everyone has the ability or the opportunity to contribute to a retirement fund, whether it be your retirement annuity, your pension fund, or your provident fund through your employer. There is a limit as to how much you can contribute, but what the beauty of that amount is that it reduces your taxable income. So it reduces the amount of money that you're paying tax on. So let's just go through these numbers. Stick with me. I'm going to go through them slowly, and I'm going to show you how much money you can save. So the percentage that you are able to contribute to a retirement annuity or your pension fund or your provident fund is 27.5% of your taxable income, up to a maximum of 350,000 Rand a year. So that's the amount that you can reduce your taxable income by. So what does that mean practically? If you earn at least 1.2 million in a year and you contribute the maximum amount, which is 350,000, you are going to have a huge tax savings, and that's the tax savings at the bottom. So if you don't contribute at all to a retirement fund, you're going to pay 421,000 Rand tax on your 1.2 million a year. That's gone. That's gone to the government. It's paid. If you pay yourself and save for your retirement, the 350,000, you're going to pay only 277,000 Rands worth of tax. That is a huge tax savings of 143,000 Rand a year. It makes no sense not to contribute to your retirement funding. This is really, and max it out, max it out. This thing protects you from yourself. You can only access this in retirement after age 55, and you got this huge tax savings each year. Keeping with the tax saving theme, I'm going to talk you through your tax-free savings account. Now, you've all heard of tax-free savings accounts. I'm going to show you exactly how they work and potentially how much you can save. So the government gave us a little bit of a free lunch and said you can contribute 36,000 Rand a year or part thereof to your tax-free savings account up to a lifetime maximum of 500,000 Rand. So what does that mean? It means that if you contribute 36,000 Rand per year or 3,000 Rand per month, it'll take you approximately 13.8 years to reach your lifetime maximum of 500,000 Rand. Ordinarily, you would pay capital gains tax on that investment. So I'm not sure you're all aware, but you are taxed on the gains on your investments. With your tax-free savings account, you don't pay any tax on this investment. So here I've just done a table where I've shown the years that you contribute. So that's the left-hand column, 1 to sort of 14, which is your 13.8. The contributions you can make, your 36,000 a year. And then I've grown those contributions at 7%, which is not unreasonable. If you put your money in the market, you can get 7% per annum over a 13.8-year period. There you can see how the money's growing. So by year 13.8 or 14, your money has grown to 813,890 Rand. Remember, you only put in 500,000 Rand. So the gain on that is now 313,890. That's kind of the gain that you would have made. Ordinarily, you would pay tax on that. You would pay tax on the 313,000, and you pay tax according to your marginal tax rate, so depending on which tax bracket you're in. So this is the tax savings with the tax-free savings account. You save between 37,000 and 56,000 Rand a year. So those are two places I've shown you where you can actually save on tax while you are investing. So if there's anything that you take away from today, just go and max out your retirement annuity or your pension fund and just start your tax-free savings account if you haven't started it before. And I'm often asked, where do we start? And I think the most important thing is that you break this down into smaller steps. So if everything you've heard today is far too overwhelming, just take one of those things. Just take the tax-free savings and go, today, this year, I'm going to start my tax-free savings account, because by the time we are in September next year, you would have made a year's contributions of 36,000 Rand. Another way of thinking about this, and I thought this was quite profound when I read it, was this mental model from somebody called Shane Parrish. He has a website called The Farnham Street, and he said, look at things differently, invert your thinking. We always plan for success. So what does success look like? What does retirement look like? You know, are we going to be sitting in Knysna sipping cocktails or on the French Riviera? Invert that. Think about what failure would look like and make a plan not to get there. And I think that's quite profound. What does failure look like? What does old age look like with no money? And let's plan not to get there. Thanks very much. That's all I have for today.
Candice, I know every time I listen to you, I learn something, and I personally love the concept of self-care. I think it was a great way of turning today's presentation into practical steps, and I think it is about that first step. You're getting some great feedback there, lots of hands clapping. So
Thank you. Thank you.
We're going to start sharing some stories. Actually, we've got a question. So should we go to the question first quickly? We do question or no question. It might not be a question. Could have been a hand clap that went into a question raised. We have a lot of those sometimes at work. So we're going to start sharing a few more personal life lessons. And I am going to start off with Amelia, if I can start off with you.
Thanks, Candice. Hi, everyone. So yeah, my biggest life lesson, financial lesson so far came with buying my house, where I didn't consider the financial circumstances or the commitments. I didn't consider that they could change in the long term. When I bought the house, I had pre-approved finance from the bank. I knew that I could pay the rates and the levies. I had lived in the area for a little while and I liked it. And I just felt that the house was worth the price that the sellers were asking. So I just pulled the trigger. I bought the house. And now 6 years later, my bond installments are the highest they've ever been. The rates have increased significantly. The body corporate has put in a special levy over and above the levies that I signed up for. And to top it all off, the house is now empty. It's not bringing in any income. And there may or may not be a termite infestation in one of the doors. So it's safe to say that there are a few things that I wish I would have done differently. The first thing is that I should have negotiated the price. I think it's always helpful to look at how much similar houses in the same area have sold for and use that as a base when making an offer. I realized that just because you can afford something at a certain price doesn't mean that you have to buy it at that price. And then there was the research aspect. It's good to look for any red flags, anything that indicates that property values in the area you're looking at might decrease in the longer term. It's good to do a Google search on the crime stats in the area. Check out community Facebook pages. People are always complaining on Facebook, so you're bound to find out what the ongoing issues are in a certain area. I think the key is that you want to make sure that the purchase is an investment and that it doesn't turn into a liability in the longer term. And then the last lesson I learned, which was a huge one, was if you're buying in an estate or complex, always ask to see the audited financial statements of the body corporate. When I moved in a few years later, we found out that we were at risk of getting our electricity cut, and the body corporate hadn't been paying our water bills. We just found out they were in huge debt, and nobody could account for the money because we were paying our levies anyway. So looking at the financial statements, you'll be able to tell whether the body corporate has significant amounts of debt. You'll be able to tell whether they're in a nice, comfortable cash position, whether cash has been spent on maintenance during the year. You'll be able to tell whether there are certain owners who don't pay levies for long amounts of time. You'll even be able to see the trend in how levies increase over the years and maybe even estimate what you could be paying in the next few years. It's a great source of information to give you insight into how well or how badly that estate or that complex is run, and that has a direct impact on the value of the property. Yeah, so those were my big lessons, but I think the key takeout for me is that you need to follow a well thought out process whenever you make big financial decisions that come with long-term commitments, because you really never know when those commitments can change and when your financial circumstances can change. I hope that helps someone, anyone.
So Amelia, it's resonating with me. Obviously, you're an accountant by trade, or by study. But the one thing my dad's always said to me is, you've got every right to ask for those financial statements. And just the way that you've explained it, I think is beautifully shared, and often the one thing that so few people think that they have the right to ask for. So let's hope you don't have that termite infection. They might be the only residents in the house at the moment from what you've just shared, but we know your other goals there. I'm going to pass on to Renee, if I can.
Awesome. So a little bit about me, because it sets the scene for my two life lessons that I've learned on my financial journey. Number one is I love shopping, especially online shopping. Number two is I can be pretty impulsive. So my first life lesson is around living beyond my means. So when I finished university, I went across to the UK and I lived there for 9 years. And my very first, I was earning a very, very, really low salary. It's quite expensive to live there. I was even living with my sister at the time, so didn't pay rent. But I got my first credit card, don't know how, but it had a £300 limit. So I thought I was rolling in the cash. The UK high street is quite an experience. For those of you who've never been over to the UK, shopping in the UK is really quite joyful, quite often. And I got pulled into that trap very quickly. So I needed the credit card to help me manage my monthly expenses, but I also got into the habit of buying things I didn't necessarily need. So in the UK at the time, I think they still do it. Credit card companies have this balance transfer process where you can basically apply for a new credit card with a new company, transfer your debt over to them, and you pay 0% interest for 12 months. So what this whole thing taught me was, number one, I had no clue what my interest rate was on my credit card at the time. I was racking up debt and I was paying a ton in interest. I needed to actually sit down and work out a budget and a payment plan for myself. And I had to take those credit cards out of the first one out of my wallet. It taught me that I can stick to a budget and that I can pay something off if I dedicate myself to it. I'm not going to lie, subsequently, I have racked up credit card debt in many years, many times. But what it has taught me is that I need to be very specific about what interest rate am I paying and make sure that I'm paying my debt off first rather than buying things that I don't necessarily need or that I want. So big life lesson for me there. My second example is around my impulsivity, and it's around lifestyle creep. So I moved back to South Africa. I bought myself a great entry-level car. It was affordable. It was really reliable, fantastic car. And then I got a new job. So what does that mean? I woke up one morning very impulsively thinking I needed a new car. And let me just say that the sales guy saw me coming a mile away. I must also admit that buying a brand new vehicle straight off a showroom floor is an exceptionally exciting experience. But I really wish in hindsight that I hadn't done that. So what that lesson taught me, or what that whole process taught me, was for 4 years I was paying an exceptionally expensive amount into a car that I probably didn't need. It taught me that I didn't know how to work out compound interest on debt, on a loan. We often talk about compound interest on investments, and that's always a positive, but working out compound interest on a loan is quite something. What I thought I would be paying every month and what I was paying every month, two very different things. I probably should have been saving that money to pay off my mortgage or my mortgage quicker, or my bond quicker, or putting it into an investment. Sorry, someone is not on mute. I just wondering if that's me. And
I'll go find them.
Thanks. I then decided impulsively again. I woke up one morning and thought, I can't afford this car anymore. I need to sell it, and I did within probably a week, which was the best decision I've ever made. I did then decide to go without a car for 3 months and used Uber for 3 months as a test to see, could I do this? I lived pretty close to work, and I used to go into work every single day. And I don't know if you'll be shocked back in the day, shocked to hear this, but the Uber cost on a monthly basis versus what I was paying in car insurance and car loan was less. So quite shocking. But just a note, if you do decide to do that, it's a break in your car insurance, and then your levy, your premium goes up. So they consider that a lack of cover, which I didn't realize at the time. So anyway, those are 2 life lessons that I learned on my financial journey, and I hope they help you. Hindsight is always a great thing, I think. And I'm very pleased that I did go through those experiences, because it's taught me a lot. And then in terms of investing, my very first investment was technically my retirement fund. My company forced me to do that. My second investment was a discretionary one in 2013, first time I'd ever taken out a discretionary investment. I was retrenched 3 months later, but I did everything possible to keep up those payments, and I'm very grateful that I did that and managed to. And then my first ETF investment, because we're women in ETFs, was in 2019. It's the Satrix Inclusion and Diversity ETF, and Candice Dott and I worked closely on that project, launching that. So yeah, thanks everyone. I hope my experiences help someone.
Amazing. Thanks, Rain. I think we can all relate to that excitement around shopping and how easy it is. I'm going to be sharing a few more lessons on compound interest in my example, and the joys and the distresses that brings. Tim Baker, I'm going to hand over to you, please.
Thank you, Candice. So I named my investment pitfall water cooler advice, because that's what I did when I worked for an investment bank, and we had stockbrokers, who were on our floor. And, from time to time, the conversations in the corridor and, at the water cooler and the pause area would be, what's the hot stock that was trending at the moment? And, at the time, a friend of mine who was a stockbroker said, Steinhoff, let's invest in Steinhoff. It's doing really well at the moment. And I jumped in head first, contrary to the wonderful advice that, advice that Candice was sharing earlier about, determining where you are in the ladder and sort of finding out where you're wanting to be, and having a plan. I jumped in and I invested in Steinhoff, and I bought shares. And I actually never looked back. I didn't even know what Steinhoff was. I didn't know what they did. I never bothered to look at the financials, understand basically what I was investing in. I didn't have a plan. I jumped straight ahead and I invested. 5-6 years later, I'd left the company. I'd lost touch with my friend, and things started happening, and in the news. Steinhoff was in the news for all sorts of, basically corporate fraud, if I could just put it quite plainly. And I basically didn't keep up with the news to find out what was going on until the stock really, really crashed and went to basically a couple of rands, really. And I lost my money in that regard. So I think that the key lesson that I'd learned there was, at the time I was really, really, new. I think it was literally my second job, and my first job I'd only been there for about 10, well, not 10 years. I'd only been there for about 2 years, and I actually didn't know what I was doing. I didn't have a plan. I didn't know whether I was saving or investing. I just, I heard that this is, a hot stock at the moment. It's a hot pick. I didn't know why I was investing in it, and I went ahead and bought it. And obviously I got my fingers burnt. So yeah, the one lesson was definitely that I didn't have a plan. I didn't have a financial plan. I didn't know where I was going, what I was investing for, what risk I was willing to take, because these are the questions that one does need to ask themselves basically when they're starting their investment journey, is to say, what is my plan? What am I investing for? What is the period of time that I'm investing? Because that'll determine how much risk I'm willing to take, and how much risk I'm willing to take will speak to what investment vehicles I then invest in. Do I invest in stocks? Do I invest in unit trusts? Do I invest in ETFs? and do I invest in money market? So I really didn't do any of that homework, and I think I got my fingers burnt very badly. And obviously the second lesson I took was that free advice is not necessarily always good advice, or at least it's maybe good advice at the time, but if it's free advice, then the likelihood is it's not intentional. So if you really don't know what you're doing, I think it is important to enlist the services of someone who's seasoned, who's like a financial advisor, who can assist you in your investment journey. So what have I done to sort of come back and bounce back from that lesson? Is that I've started looking at investments like ETFs, exchange traded funds. And I know we've spoken about it and mentioned it a little bit, but exchange traded funds, what they are really is a basket of shares that have a similar, basically similar, what do you call it? They follow a similar pattern. So they follow a specific index. I don't know if you guys know, but I remember growing up, we used to have, my father used to watch the news, and my parents used to watch the news, and towards the end of the news channel, there'd be the financial section, and they'd talk about stocks and commodities and the JSE top 40, and I always wonder what that is. And years later, now that I'm in this industry that I'm working in, I'm aware of what that is. And basically it's an index, and it's an index that comprises of 40 of the biggest stocks listed on the stock exchange. So basically that's one example of a basket of shares. And there are many different types of baskets when it comes to ETFs. The S&P 500 is an example. The industrials is an example, where it's industrial companies, or financials. The FINI 15 is another example of a basket of shares, which is just stocks made up of financial companies. So I thought that was a better way to start investing, because then you're not having to do the homework behind picking the individual stocks and understanding the company's financials and their revenue, their costs, and so forth. You basically just invest in this basket of stocks, and it's the index provider that does the work for you. And I think I find that with investing in ETFs, it's more your risk is diversified, in the sense that you're not investing in a single stock, in the example of, in my case, sign-off, but you're investing in a basket of stocks. So I find that is better than investing in single stocks, and I have basically stuck to that. And stopped accepting free advice and not having an investment plan for myself. So those are my lessons learned.
Thanks, Thembeka. I feel like I can resonate with that TV watching and always waiting for the financials to come up. And certainly there were 2 pages of a very large newspaper that used to host quite a lot of financial data, which used to mesmerize me as a child, because you could never quite figure out what all of it meant, but you just knew that. Certainly my dad also spent quite a lot of time looking at those 2 pages more than any of the others. And my grandfather too, in fact. And I think I was blessed, and that's where my story actually begins. In some ways, I think, having been brought up in a household of family members, certainly my grandfather, who worked for Standard Bank, and I spent quite a lot of time with my grandparents, and then my dad, who worked for Standard Bank. So I pretty much grew up being a blue-blooded child, and not really, realizing how many other banks there were out there. I learned quite a bit through dining room table chat, I would call it, and like water cooler chat. I certainly can't say that I understood it all, but some of it must have gone in, because it's been a profession that I fortunately knew I wanted to go into from very early on in my life, which I know not many people have that benefit. And I think for my sins, I'm still super passionate about being in the financial industry and the impact that some of us can have in the industry itself. So my lesson goes back to some of the stories shared from Renee and Thembeka. compound interest. Boy, what a phenomenal concept, and certainly I believe it's allegedly described by Albert Einstein as the 8th wonder of the world. Okay, so when you understand the magical powers of compound interest, they certainly help you understand the need to start investing early. And it does not matter what the size of those investments are. If you can't afford a lot, it is certainly important to save a little, starting very early on in life. So adopt the motto of saving early and often. Compound interest is one of those things that I spend quite a lot of time trying to share lessons learned with friends and family on. And a recent example is a close family member of mine has recently started out in their career, started earning some income. Certainly to get the job that they are in today, they needed to take out a loan to pay for their studies. And that study was actually a year's worth of culinary school tuition. And unfortunately, they were unable to afford to take that loan out themselves. They didn't, they had to rely on some friends and family to help them. And the friends and family themselves weren't in a great financial situation. So they actually used short-term finance to pay for the individual's year's worth of tertiary education. And I was aware that he had to pay off that loan once he started working. And he got a job, and a fantastic job at that, but not earning a lot of money and working very, very long hours, and realized that, much like Renee described, also got very excited with his first paycheck and decided to buy a new car because he needed to get to that new job. So being the sort of advisory family expert that I claim to be, and I certainly am not that, but I do get asked lots of questions. I try to guide him in two ways. One was to try and help explain what compound interest is, and certainly understanding that he had the short-term loan that he had to pay off for the year's worth of study, and now had managed to amass a car loan at the same time. Now, both loans were quite high interest rates, and it was really important to understand the concept of interest rates on loans and the variability of interest rates on loans. No loan is the same, and also the terms of those loans are really important to understand and read through. And you can't just pay off loans the minute you may come across some cash. So the ability to pay off a short-term loan for his studies wasn't something that he could do, because actually the terms of the loans prohibited him from doing that. And my advice was to try and reduce the amount of debt he had to pay off. And one of the options was to start, he wanted to also put some money aside to start saving, which was really the lesson that I wanted to share here. It was very important to work out what his debt obligations were from a compound interest perspective. So interest on interest, when you have debt, can really rack up. Compound interest when you have savings can also be extremely beneficial. And the two are not equal, unfortunately. And I think when you're young, it's super important to, and it's not just when you're young, in fact, it's at all ages. My guidance to him was to not try and put the 100 or 200 Rand away in a savings account. It was more important to advise him to try and diminish his debt obligations as fast as he could. So for me, the lesson learned out of this, and I think he's now got himself into a situation where the higher interest rate loan that was due on his academic tuition year was paid off first, and then he's still going through loan car payments. But he's now in a position where he's at least been able to reduce the higher interest earning debt. So just some guidance on this. Interest on interest can be extremely powerful. Compound interest, for those that don't understand, and I'm just going to use a quick example here. When you have savings, and to put a simple example out there, 100,000 Rand in a savings account that's earning a 5% simple annual interest rate can earn 50,000 Rand a year. If you have the same deposit and you're earning monthly compounded interest of 5%, your annual interest earned is 64,700 Rand. So you can very quickly work out that understanding the difference between simple interest rates and monthly interest rates can help you appreciate more earnings on your assets. The same calculation applies when you have debt. And I want to apply this specifically to things like, and many lessons learned with family members that I've had experience having to help, where short-term debt like credit cards, Ren, you used your great example, store cards, we've all unfortunately probably got a few of those. And I say that unfortunately because store cards charge very high interest rates. Unfortunately, that's something that is a fact. And it is super important to understand the terms of those eye-wateringly high interest rates at times and ensure that you pay them off as soon as you can. So before you start thinking about putting some savings aside, try and pay off your debt as fast as you can. So some of the pros and cons there from understanding interest and understanding the value of compound interest. I personally like Tembeka's example from an ETF perspective. My retirement annuity is invested in ETFs, and I particularly like the value of the index investing aspect that she explained, but I also particularly like the fact that they're lower fees. And the management fees associated over time help to accrue sort of a compound interest effect towards the asset over time. Two more quick tips, and I did some surveying of some colleagues of mine, and I actually thought these two that were super helpful, short, sharp examples of, we've talked a little bit about the importance, Candice, you raised about having a will. I think it's important for people to understand that executors' fees are negotiable. And that was a reminder and a tip from some colleagues of mine that I just wanted to put out there. Something that you should be asking when you are setting up a will is certainly understanding executors' fees and understanding your negotiable state around what those fees are. And then last and final tip, again, around the sort of debt scenario, is if you have a mortgage. And if you do have perhaps a bonus that gets paid annually, or perhaps you are fortunate enough to have some income coming in, perhaps through some other means, you might have some other business interests on the side and you have some extra income, use that income to pay off mortgage debt if you can. Certainly back to this theme of trying to decrease debt obligations allows you to start thinking about investing faster and sooner. And those are some of the lessons I wanted to share. I think from the purposes of today and moving on to some questions, if that's possible, if anyone has any questions and you want to ask them, now's the time. We're all very keen to see what's on your minds, what we may have shared. If you're not quite sure what we've shared, you need a bit more detail, please ask us. I think from a questions and answers perspective, there was one or two. I'm not sure we can help with the bathroom renovation situation. But were there any other questions? I think, Lee, you've got your hand up, so let's go to you first.
I'm just unmuting myself. Firstly, thank you very much for the presentation and really great day-to-day advice for everyone on the panel. Just one or two things I just wanted to share, that retirement comes closer than you'll ever think. I turned 65 myself in December, and who ever thought? I mean, I feel 30. I think I'm 30, but I'm definitely not. But two of the advice you. Firstly, it starts, if any of your parents, start it with your children from a young age. And my philosophy has been my entire life is save first before you spend. And it's linked very much to spend less than you earn, because you actually get used to the net amount that you've got. So as soon as you get your salary, your commitments and savings must go first. And the way sort of embedded that in my children is from when they both were in high school and they started and got allowances. It was teaching them how to budget. But the day I opened their account, we opened 2 accounts. And I said, as soon as the money goes in, 10% is going to the second account. And at the end of the year, you're going to have that much extra. But come the end of the year and they saw this amount built up, they said, no, let me just leave it grow more. So I started that mindset in my kids. To me, cash is king. And I'm now thankful for that I stuck to this my entire working career and have taught that to my kids as well. So I just wanted to share that with you.
Thank you, Lee. That's super good advice. And thank you for sharing the example of how rewarding it can be when you see interest on savings and the value of actually wanting to continue to see that earn. I think probably better explains my example. So the magic of compound interest and investing early. We've got some resources. Sorry, there was one question here, and I'm actually going to pass that on to Tembeka or Emilia, if you don't mind. How does Lisa asks, how does one go about investing in ETFs, and who do you contact?
So Lisa, there are various platforms out there that one can use to invest in ETFs. You just need basically a broker. So you could, I mean, like if in the online share trading, there is easy equities. There are various trading platforms basically that you can buy ETFs from. So remember, ETFs are like listed stocks. So basically, anywhere where you can buy listed stocks, then you can buy exchange traded funds as well.
We've got some resources that we'll share shortly that might give you some guidance on some places to look. It's certainly not a complete list, but it's a starting point, which will show up in a second. Candice, there's a question for you around some of the numbers that you shared earlier around retirement tax saving. And are the numbers based on a specific product or retirement contribution through your employer? Nicholas has got that question.
So the numbers based on specific product. And okay, the numbers that I shared, and maybe I should just bring up the slide again around retirement funding was the allocated amount that you are able to, I'm not sure if, let me just have a look if I can find the slide. So everyone is able to save a certain amount into their retirement funding. There's the slide. Just have a look. And the way that you calculate that is based on your taxable income. So these are tables that are given by SARS essentially. So your taxable income is pretty much the amount that you earn. And so what I say, and you can save 27.5% of what you earn every year, and that reduces your taxable income. So for example, in my example here, if you earn 1.272727 per annum, you can contribute a maximum of 350,000 Rand a year, and the whole 350,000 you are able to deduct from your taxable income. So essentially you are paying tax on a lot less, and I think the number is around about 900,000 Rand that you will pay tax on it, as opposed to 1.2 million. So you can choose what you want to contribute. You can even over contribute. It gets a bit complicated, and those over contributions will be saved into years in the future. But to max out this benefit, take the 27.5% of what you earn every year and put it into your retirement funding, whether it be your employer's pension fund or a retirement annuity, and you will save the tax on it. I'm hoping that I'm answering that question correctly.
Thanks, Candice. I think if Pelissa needs more, she can ask.
Yeah.
If there was one more that while you actually have your slides up, sorry, it might just be worth flashing up the resources page just to sink Lisa's question in, because I think it was one that we wanted to make sure everyone just some tips, some suggestions. We just grouped together some of the places we've gone to, or places and things that we use. So podcasts, we've got a couple of radio stations, we've got some websites, we've got some people to follow on X, just a handful on one slide. So if you need to take a screenshot of that page, we can try and copy and paste them into the chat. I think Candice, you talked about the first book on that list, but you've got a few more books that you have read that might be helpful.
Yeah, so maybe we can just talk through some of these.
Thanks.
There's a huge amount of resources out there on the internet, speaking to people. And I think what's important is when you're going to start reading about finance, as in if you start reading about any subject matter, you'll see a golden thread starting to appear. You sort of need to triage the data. So you don't necessarily need to take one person's opinion for things, but what you will start seeing is people are talking about tax-free savings account. People are talking about your retirement funds. People are talking about the things that we've spoken about on this website. And in fact, just in sharing our money lessons, you can see the thread coming through there. Start early, watch out for interest, read the fine print, the devil's in the detail. So similarly, through these resources, you will start seeing that too. And we've just put these together because they've been things that have helped us collectively in the past in various ways. You know, the other thing was there are a huge number of podcasts out there that you can start listening to as well. But once again, if this is all completely overwhelming and this is not your wheelhouse, outsource it. You know, you outsource heart surgery, you outsource IT, you outsource a whole bunch of things. You don't have to be a specialist in this as well. Life is complicated enough. So really do think about outsourcing if all of this is overwhelming.
Kind of like that, a vision came into my mind, which is there's somebody to hold your hand to get onto that first step. And there are actually a lot of people to help hold your hand to get onto that first step. If anyone on the webinar has other resources that they enjoy listening to, or things that have helped them with their decision making around investing, or managing their taking care of their financial wellness, please share them on the chat, because I think there are a lot of great ideas out there and a great number of resources that not all of us even know about. There's a question around tax savings accounts. Candice, also again, maybe one you might be able to answer, particularly like the on behalf of your children part of Nasipo's question, which was, are you able to open multiple tax savings accounts, and can you open them on behalf of your children?
Yes, you can. You can have one per person. So you may own a tax-free savings account, and you may open tax-free savings account for your minor children. And you can do that through places like Satrix Now, Easy Equities, and you can invest in ETFs for them. So if you're opening up for your children, it's a wonderful gift for them, because by the time they are 13.8 years old, they'll have reached their lifetime maximum and they'll be on their way. And the compounding story comes in there, the beauty of compounding. If you left that tax-free savings account and your children didn't touch it for another, 13.8 years, they would have this enormous amount of tax-free money, given that you'd invested in the stock market. So yes, each individual can have one tax-free savings account. There's one point that we wanted to make around this, and you need to be careful. And this was Renee's point, and I think it's important. Do not over-contribute to your tax-free savings account. The government has said 36,000, they mean 36,000. If you put in any more money, they are going to penalize you at a rate of 40% if you over-contribute. So don't get clever and don't open up on multiple platforms, because you need to keep track of that too. So stick to the rules and it will work. It really will. The other thing is, if you withdraw from your tax-free savings account, you cannot add that money back. So ever. Okay, so just kind of understand how to manage your tax-free savings account and just to kind of stay in your lane with it, and it'll work out for you.
So Candice, on that front, and it's something that I've personally also been very interested in, is that page that you showed earlier with the calculations. That 36,000 is a per annum allowance.
Yeah.
So you don't
yeah.
get to, look at the total amounts at the end and say, oh, I can do that over multiple time frames. You have that in a year, and if you do take money out in that same year, you lose that access to be able to top it up. You're effectively doing yourself in a little bit.
Yeah, if you withdraw from it, Candice, but you don't have to put in 36,000 in a year. You can put in 10,000 in a year, miss a year, put in 5, miss a year. It's just going to take you longer to get to your lifetime maximum. So the way to optimize it is to put your 36,000 in and get your lifetime maximum as quickly as possible, so that you can start compounding.
The magic of compound interest.
Yeah.
Okay. Sorry, one more there, and I don't know. Thanks, Renee and Amelia, for stepping in with some guidance on the bathroom situation. Can I have a tax-free savings for myself and then a separate one for my son? I think you may have just answered that, or would that be considered a double savings? I think we may have maybe helped there. Any other questions from anyone that they want to ask in person or on the chat? Hopefully this has been helpful. So could you open a tax-free savings account with 36,000 Rand? I think the answer is absolutely yes.
Yeah, that's right.
Okay, so a couple of questions that I think we want to also try and answer. And I think one question that's been quite topical is, if you are fortunate enough to be able to talk about investing in the context of diversifying your investment options, I think a lot of people have been wondering about whether you should put your money offshore, or if you should put all your money offshore. Candice, can you maybe share your views on that?
Yeah, sure. So there's a huge temptation to just take all your money offshore. The Rand is a scary thing. Our politics isn't great. Every day we're getting poor economic news. But I would guard against just putting all your money offshore. So while you're living in South Africa, you have liabilities in South Africa. We do have a fantastic interest rate. So it's been pointed out that the interest rate can work for or against you. And if you're a saver and you're compounding at our high interest rates, that is fantastic. And there is an element of a guarantee there.
Yes, I can talk though.
So I think, sorry, someone's got their mute off. So I think while most South Africans should have a large proportion of their investment portfolio offshore, because you can get access to global markets and stable currencies, you need to look at your personal circumstances. Once you've decided what that percentage is, there are wonderful places to invest from a Rand perspective and taking your money physically offshore. Taking your money physically offshore is quite onerous from a tax and a probate. So probate is how it falls into your will perspective. So the easiest way is, once again, through ETFs. So one of the ETFs that I really like for my clients is the Satrix MSCI World ETF, and most ETF providers have a World ETF. And what that does is you can invest in portfolio managers, physically take your money offshore and invest it offshore for you. You get the growth on the global markets, you get the protection of Rand depreciation, and when you want to disinvest your money, you can bring it back in Rands. So these offshore ETFs, doesn't really matter who the provider is, are great for your tax-free savings account. So consider putting your tax-free savings accounts into the offshore ETFs, because you're going to be investing for a minimum of 13 years.
Thanks, Candice. It's super helpful. One more question. I think just Amelia, maybe you could help answer this one. Are there some basic tips or principles to follow to get on that first step towards financial wellness that you could maybe help summarize?
Yeah, sure. I think the basic tips are firstly, track what you're spending. A lot of the time, we don't even like to look at our bank statements because you're going to learn the truth about what you're actually spending your money on. Sometimes we don't even want to see it. So I think track your spending, know what's coming in and what's going out, and then create a budget. But also stick to the budget. Creating it is not enough. Stick to the budget. And then once you get a bit of stability, try to pay off the big debt that you have. Sometimes it's student loans, short-term loans, things like that. And then formulate an investment strategy. And at that point, you might want to bring like a professional in, or just start to upskill and gather information and, follow an investment strategy.
Thanks, Amelia. I don't think that we have any more questions. There are a couple of requests for contact details. So I think, Candice, are we able to share your slides at all? I think Colleen might be able to disseminate them. But certainly somebody wants your contact details, which I think is testament to how phenomenally you've shared today. And there are a couple more questions on just details on the website. So, Rain, you can probably put in some links there, I think. Is there another session? Well, that's testament, Joyce, to thanks very much. I'm hoping you've managed to take something away that's been helpful. And like we said, we all intended to set out today to leave you with, even if it's just one nugget of something that you didn't know about or didn't think about before, that you leaving today's session saying, oh, I think I need to understand that a little bit better. Or perhaps I need to find somebody's hand to hold me along this journey. I think, Ren, you reminded us that September was Will Month, if I'm not mistaken. So you're starting to see quite a lot out there from the different service providers. Something that was quite eye-opening to me this week was the work that's going into AI in the wealth space, and certainly some providers doing hyper-personalization in this space. So just a word of caution and curiosity to everyone out there. As you share your details, or perhaps sometimes you don't choose to share your details, but your details are certainly out there around your own personal financial situation. When you do get confronted with hyper-personalized interactions, and those are from perhaps service providers that you know, and in many cases where they're service providers that you maybe do not know, most importantly, they're taking the information that they think they have about you and what they think they know about you, and in many cases what you may have shared or not shared with advisors or people who are holding your hands. People don't always tell the full truth and the whole truth when it comes to financial or personal finance. So my word of sort of just pay attention to hyper-personalization, because it can be super tempting. People solicit some pretty hectic information out of you, or seem to come across about knowing a lot about you, your family, or other things. So just be cautious, be curious, understand how some of these technological evolutions in the wealth space are taking place. Some of them are absolutely fantastic and are going to support you along this journey and actually co-pilot you, my word of the week. That will take you on this journey and actually help you the whole way through. And some are actually going to lead you down some of those water cooler tactics that I think you need to be super aware of and cautious of. Ren, you've got your hand up.
Yeah, it was just another tip. Yeah, you did. Just another tip. That's something that we try really hard to educate our investors on from a Satrix point of view is scams and fraud. Just always be very vigilant and careful about who you trust and where you get your advice. If people promise you crazy returns overnight, or they put pressure on you, just be careful, please. That's just something I wanted to just mention.
I think Tim Becker used the term, there's no such thing as free advice.
Yeah.
There's no such thing as a free lunch. So definitely don't trust everything that you see or everything that you hear. And today was certainly just us sharing some of our stories, some of our own personal experiences, understanding some ways to get that sort of helping hand on the journey that you might be on. And again, the journey might be not just your own. I think importantly, and some people have commented in the chat that they you know, helping support family members, they're helping support friends, they're helping support wider ecosystems than themselves. And I think that hopefully we've left you with some things to consider, some things to share. Those resources really were just the tip of the iceberg. But again, if you found it useful, maybe we can come back next year with some extra tips and extra words of advice in the Business Engage calendar. But certainly start now. Don't leave it. Don't leave today's call and sort of put it on the back burner. This is something that you have direct control of. This is something that I think only you can do something about. You can't wait for somebody to do this for you, unfortunately. Unfortunately, the stats aren't really in women's favors there, to be quite frank. We often leave that to our counterparts to do this for us. And that can also be to your family's detriment and to your detriment, should something happen. So take the bull by the horns, put your own fate into your own hands, and hopefully we've left you with a few things. I'm also going to ask Amelia quickly if she could just share the best way for anyone that's interested to join our WE family. Amelia, what's the best way for people to contact WE?
Yeah,
And
sure.
us?
So to become a member, you can just go to womeninetfs.com and select become a member. There are membership options for students and then normal memberships. You'll be asked to select a chapter. Please select the WE EMEA chapter. And if you're having any issues joining, I'll just put my email address in the chat and you can contact me directly. And I'll be happy to help.
Thank you so much, Amelia.
Sure.
And Candice, Renee, Tembeka, anything else final words of wisdom? Anything else anyone else wants to share before we go? Thanks, Renee, for putting the link in.
I'm going to follow everyone's advice just again this weekend.
I think your advice was pertinent. Don't walk away from this and do nothing. Just do one thing, do something. Just start.
Yeah, absolutely. And I think in as much as we talk about self-care in other aspects, financial self-care is also self-care. And I think when you look at it like that, for me, it makes it so much more real and practical. So yeah, thank you, ladies. And I wish everyone the best in their investment journey and their financial self-care journey.
Thank you. That's amazing. And maybe make this your gym workout for the day.
Exactly.
It's certainly been a mental workout for us, and we've taught each other things along this journey. So I don't think you ever stop learning. And let's come back next year, maybe, ladies, and share some more anecdotes and some more stories if Colleen wants us back. And if obviously you've got any questions or follow-ups, you can reach all of us. You've got our names. We're on LinkedIn. We're on all sort of different channels. You can reach us through the WE link. Amelia can probably connect you to some of us as well now that you've got her email. But thank you so much. It's been amazing working with Candice Payne, Amelia, Renee, and Tembeka. Thank you so much for helping co-pilot this journey today. And I really hope that we've been able to impart a few sprinkles of magic on everyone that's been able to join. So thanks, ladies, and have a lovely Friday. And I hope you get the warm weather you need, Amelia, in Cape Town, and Candice too.
Bye.
Thanks,
Cheers.
everyone.
Bye, everyone.
Bye, everyone. Bye.
Thank you.